Welcome to today's webinar with Diversified Energy PLC. I'd like to now hand over to Rusty Hutson Jr., co-founder and CEO.
Okay, thank you all for attending today. I know it's late in the hour in London, and so we appreciate you taking time to hear our pitch on the first half of the year. This is Rusty Hutson. I'm going to start it off, talk a little bit about the highlights of the first half of the year. I'll cover the operations slides as our Chief Operating Officer had to step away for the rest of the day. And then I'll let Eric talk a little bit about the financials and kind of what they look like for the first 6 months. And then I'll finalize the presentation with a discussion around the rest of the year. And then we'll turn it over for some questions. Flipping to page 4, which is on the screen. Really some highlights here as it relates to the first half of the year. Obviously, our production, 106,000 BOE per day on average for the first half. And that was a record, slightly higher than last year's fourth quarter. But more importantly for us was the exit rate after doing the closing on the Indigo transaction in late May. The exit rate for June was around 116,000 BOE per day, and that will continue to escalate as we close Blackbeard in July and Tanos this month in August. So daily production pretty steady, especially on the existing portfolio. We did 3 transactions in the first 6 months, either closed or announced. $342 million was the purchase price, representing about $120 million of EBITDA. All of those were in a new central region that we discussed during the presentations for those acquisitions. That new central region, we see it as being key to our growth going forward, along with Appalachia, because it gives us the ability to really replicate what we've done in Appalachia in this area. A lot of fragmented production and ownership of assets, a lot of assets that most of the big shale players would consider to be non-core. Gives us the ability to acquire at very compelling valuations, and we'll talk a little bit about that. Our EBITDA margins continue to be very strong, even with the Indigo transaction that came in late May into June. We didn't get a lot of benefit from it, but the margins still were above 50%, which again drove very high free cash flow generation. 117 million. We had EBITDA of 151 million, free cash flow of 117 million, and Eric will get into kind of how that was split between dividends and debt repayments. Couple other notes. Oaktree, obviously, most people on the phone are probably familiar with the agreement we had with them that we signed late last year. We were able to get them into 2 transactions for the first time in this Cotton Valley area of Louisiana and East Texas. So they are now $200 million of invested capital into a $1 billion commitment. And so we're excited to have them in their inaugural deals. And then progress on our ESG initiatives. This is a big deal for us. We treat it with a lot of urgency, and we continue to make a lot of progress here. And really, if you go back and look at our last 2 sustainability reports, you'll see significant improvements from year 1 to year 2 in the disclosures, improvement in the intensity levels of our emissions. And we'll talk about that later. We have a scheduled Capital Markets Day in October, first part of October. The actual day hasn't been scheduled yet, but it will definitely be in the first part of October to discuss in great detail the ESG initiatives that we have on our plates. In the operation side, obviously ESG. A couple things on the environmental side. Emissions is a big thing for us and the thing that we're targeting the most. So we've employed some technology in the field on our midstream side to detect emissions so that we can correct them. So it's detect and correct. And that equipment was working so well for us that we've decided to put a capital investment into 100 new pieces of equipment that we can then put into the hands of our well tenders to identify those emissions at the wellhead that we can then start to reduce, starting at the greatest, first. So that's something that we'll discuss in more detail later at the Capital Markets Day And then on the plugging and abandonment side, we're far into our required plugging for the year. We're continuing to bring down the costs. We've put in place our own plugging crew, which has reduced costs by 25% on a well-by-well basis. So that's becoming more and more critical to us and making sure that we're bringing down our costs, but also affecting the requirements that the states have asked us to do. Social wise, you can read all these here. We continue to be very, very engaged in the communities in which we operate and with our employees and the wages we pay, the taxes we pay into the local and state governments. And then, from an educational perspective, we have been sponsoring scholarships for students to the universities, and just a lot of different things as it relates to community involvement. And then on the governance side, obviously last year we spent a lot of time in improving that and strengthening our governance, especially as we became a FTSE 250 company. We still have a few things that we're working on, but we plan on wrapping most of those up. But from a governance perspective, it's all about transparency and driving, behavior related to the ESG movement through our incentive programs. Flip the page, please. Deploying and consolidation, the strategy in our new region. Obviously, the central region is going to become more and more of a focus for us as we move forward. We see a big benefit there, a big opportunity set. You can see down here in the right-hand corner, the map and the way it's shaded in. That central region represents, in addition to the wells that we've already acquired here, 169,000 vertical wells and 49,000 horizontal or directional wells drilled in this box or in this shaded area. That represents about 24 BCF equivalency per day, which 90% of that is natural gas, which again goes back into our ESG story and the fuel that we like to produce, which is natural gas. So it's a big opportunity set for us. With the assets that we've already acquired, we've onboarded all the employees for Indigo and for Blackbeard. We obviously will be doing the Tanos employees really quickly after acquisition. We've started to integrate the assets and look at ways that we can benefit from a cost efficiency perspective. We see a lot of good opportunities there, and also from an enhancement of production. The thing that we really love about this area and about the assets that we're looking at is they're non-core, and typically not a lot of time and attention has been placed on those with the previous owners. And so that gives us a lot of low-hanging fruit that we can go in and take advantage of. The other great thing about this area versus our Appalachian asset base is the basis differentials here are much, much more compressed. You have access to markets that we don't have access to in Appalachia, specifically the Gulf Coast and the LNG facilities that are there. So there's good gas takeaway capacity, a lot of pipeline infrastructure, and basis differentials, which we've seen, in Appalachia anywhere from 60 to 90 cents on negative. Here, we're seeing anywhere from plus 5 cents on Houston Ship Channel to negative 20 cents. So a big improvement of close to 80 cents in the gas prices there. And then we'll continue to look for other opportunities to add to the portfolio to continue to drive the scale that we see that this area provides to us. Production wise, we talked about the average net production for the first half of the year. We talked about the exit rate being at 116,000 BOE per day. If you would have taken all three of the acquisitions that we did and pro forma the production on those assets for the first half of the year, along with our existing production, that would have represented about 141,000 BOE per day, which would have been a significant increase, obviously, from the previous year. And we'll see that start to trickle in as we go through the second half of 2021. Some of the other things here are decline rates. We have the lowest in the industry. We have a slide in our appendix, we're actually going to move it forward later so we can have it handy, but you can see on an average annual basis, when you compare us to all the other North American E&Ps, I think these are public E&Ps, you can see 8.5% is by far the lowest. 12% is the next highest, and then 20 and up from there. So we don't have to I call it run on the treadmill as much as some of these other guys do when it comes to replacing reserves on an annual basis. And so that we have a very, very good understanding and visibility into our production profile on a going forward basis. It affords us the opportunity to hedge that out pretty substantially and lock in the returns that are necessary to operate the business, pay down our debt, pay our dividends to our shareholders. To flip back to that first page. And so that's extremely important. And it's really all related to our smarter asset management program. We're able to go in and we call it smarter asset management. I call it operating wells. And what we have found over time is the companies that are really good at drilling and completing wells don't really operate existing production very efficiently. So we love to buy behind these guys and be able to go back in and really show how we can arrest decline rates in the portfolio and see that value brought forward. And so we're seeing that happen not only on our Appalachian assets, but we see opportunities to do that in our new central region. And then talking about some of the vertical integration, we have some revenue optimization. This is in Appalachia. You can see over to the right a copy or a picture of the pipeline that we're installing and getting pretty close to completing. This was a big pipeline project that we did. It's rerouting. The benefit of this is rerouting gas from a market where we get less money to a market that pays us better gas prices. And so this gas that we're rerouting will be able to result in a realized price increase of approximately 25%, which is significant on the gas that we're moving. And this pipeline project, as big as it was and as costly as it was, it'll have a 20-month payback from start to finish on a cash-on-cash basis. So, and then a long-term tail of additional revenue that we wouldn't have had otherwise. So it's a big project for us. And then we always look at expense optimizations, looking at ways to, for example, in this case, take our midstream assets, buy them, take the margin out of what the previous owner was charging to move our gas, and we can recognize that directly, but also charge third parties to move gas on our pipelines, which is a revenue stream that we wouldn't have otherwise, and is very margin enhancing. So all of these kind of things, we call it creating value through our vertical integration. We want to be as less reliant upon third parties as we possibly can. We'd like to control our own destiny. So with that, I'm going to turn it over to Eric and let him talk about the financial highlights for the first half of the year.
Thanks, Rusty. As you can see, I'll pick up on page 11. I won't really spend a lot of time narrating this slide. You'll all appreciate that we posted a very fulsome mid-year report along with the RNS this morning that goes into all of the details. You've got all the accompanying footnotes and disclosures. What I will say is that there's one thing that stands out in the results, and that's obviously the hedge non-cash mark-to-market, or what you see on the third line there, the gain or loss on unsettled derivative instruments, $371 million during the period. Without context, that can be a rather jarring, but when you really unpack it, you begin to see it's not only not a true liability to the company from the standpoint of long-term value creation, it really creates opportunity for us. And so we want to make sure that we provide proper context to that and hopefully distill. The reason that there's volatility through the IFRS income statement is because we elect to account for, we do not designate our derivative contracts as hedges for accounting purposes. So the changes in fair value go through current period earnings, even though this is a very long dated hedge portfolio. So we'll talk a little bit about that. Importantly, if you go all the way to the very bottom of the page, you see very healthy cash margins, nearly $8 per BOE, consistent across all periods. So if we scroll down to page 12, the theme that you find in our financial statements, absent the hedge mark-to-markets, is a constant stability. We really want to focus on stable production, driving stable cash flow, because from the beginning we've been about returns to stakeholders, and that's dividends for our equity investor and it's debt payments for our debt investor. And in order to do that, we want to take as much commodity price risk off of the table as we can. And you can see we've been successful in doing that. If you look on the left-hand side of the page where we show our realized pricing, you see a very stable $15.36 across the periods, despite the fact that unhedged prices would have been as low as 1068 or as high as 1690. But we've delivered very consistent results. In the first half of 2020, our hedge book added 45% to our realized price. In the second half of the year, it added 27% to realized price. And in the first half of 21, as prices continued to rise, it gave back 7%, but ultimately delivered a very consistent price across all periods, which allowed us to deliver a very consistent dividend payment along the way. If we move to 13, we talked about, $371 million that went through the income statement in just the first 6 months alone. Then that added to some mark-to-market liability that you saw emerge on the balance sheet at year end for a total hedge liability, unsettled mark-to-market liability of about $537 million, which can be a bit daunting. But it's important to remember that is a 10-year payment stream. So you can see what we tried to show here is that we have a very long dated hedge portfolio that underpins the low cost financing that we have, as well as the very long lived assets that we have. And so if you look across that horizon, you see the foundation of the graph is our cost structure. And then the green line through the graph is our hedged price. So that shaded region represents a positive cash flow margin that spans for the full decade. And it's that margin, that positive free cash flow that pays our dividend, pays our debt, and then allows us to reinvest into the business in not only a sustaining way, but in a growth oriented way as well. And we'll talk about that in a little bit. If we had not been disciplined with respect to how we protected our cash flow, you can see the gap we would have had in 2019 and 2020 and coming into 21, where those derivatives that we put in place paid out, so cash in the bank of $194 million. And so we certainly realized significantly higher revenues as a result of those hedges. And in the first half of this year, we gave back just $22 million. So of course, over that period, 90% of the hedge effect was net inflows to us. And it was because of that strong hedge protection that we were able to not only sustain our dividend during the COVID shutdowns, we were actually able to increase our dividend twice with confidence that our cash flows would be there because our production would be there from newly acquired assets. So in 2020 alone, you'll recall we made $118 million in dividend and share repurchase distributions for the benefit of shareholders, while also paying back $82 million of debt. And we were able to do that because of the hedge protection. But if you move forward, the natural gas price curve has gone up, and that's, if you'll stay on 13 for a while.
Absolutely.
So you'll see that dotted red line is now going above our hedged green line. And so that rise in natural gas prices creates a payment liability on future production if in fact those prices ultimately are realized. And you can see the quantum of that with the stacked bars across that time horizon. But what's important is that any unhedged volumes that we have in those same periods will realize that higher price. And so unhedged volumes actually benefit from higher prices, which is a net positive to the company. So we'd much rather be in this environment than we would where our hedges are worth significantly more and we're losing value on the unhedged portion. And it's important to remember these are potential upside foregone, but very real downside protection. And so we certainly hope natural gas prices stay high. It certainly bodes well for long-term value creation. We'll talk about what it does to our reserves on the next slide, which if you look at where the forward curve was just a year ago, you can see all the way out to 2030 that at the very farthest end of the curve, it was just under $2.70. And today, that same curve sits at just about $3. So a 15% price increase across the full back of the curve, about a 20% increase about in the middle of the curve, and a 45% much steeper increase in the front end of the curve. And that's why, the volatility generally sits up front, which is where we would like to take the volatility out to make sure we protect our cash flows. But where you see the opportunity in the value creation is that while we're significantly hedged in the front end, so I only have 10% of my volumes unhedged for the remainder of this year. I've got about 25% of my volumes unhedged for next year. I've got 70% of my volumes that are available to capture that upside in those outer years where we've seen a nice increase in price. And this is what we plan for. We know that the commodity price is cyclical and that it rises and falls. We like to take that volatility out of the equation with hedges, but recognizing we want enough upfront protection to weather the volatility to make sure we deliver strong margins, strong cash flow. But then as we see the curve move up again, take the opportunity to continue to layer on that front end protection and remove the volatility from those early years where you generally see it steepest. If you take the uptick in prices at 45, 20, and 15% across the horizon, and you match it with the production that we have available to capture that, it ultimately results in a potential ability to widen our margin by 10%. And so Rusty mentioned we had 50% free cash flow margins on or EBITDA margins on our production in the first half of the year. This demonstrates that we have the potential to take that as high as 60% through pricing along before we even get to expense reductions, which is obviously always a part of the strategy. But if you distill this all down, and the point we make in the upper right-hand text is that with this price increase, our reserve value, so the long-term value of the unproduced commodity that we have, increased by $1 billion. And so you have seen a liability on the balance sheet of about half of that. But net, that means that our overall reserve values have increased by 15% if you net off the hedge liability. So it genuinely is a real positive when we say higher commodity prices that do drive that valuation non-cash mark to market through the P&L. So margins is obviously our focus. It's always been our focus. And as we exist in Appalachia, which are represented by the green bars, you'll see that we really focus on the expense side of the equation. The pricing dynamics in Appalachia are quite stable in that you have Henry Hub, less a basis differential. And those basis differentials, as Rusty alluded to earlier, can be significant at times. And we also use hedges to help mitigate the price volatility there. But from 17 to 20, you've seen us drive our operating costs down through incrementally building scale with acquisition after acquisition, driving costs down by over 45% per unit. And so tremendous cost compression, which if your two inputs are prices and costs to enhance margins, you've seen how by driving down costs, despite the fact that you had prices dropping, and you see in 18 it was $18, and in 19 it dropped to just under 16 or $16.50, and then all the way down to nearly $15 in 2020. But despite that price reduction, because we were actively reducing our costs, we were able to take what was a 40% margin in 17 and improve upon that all the way to a 54% margin to round out 2020. As we look at the first half of this year, we talked about our strategic entry into the central producing region. And while the central region, which is situated in Texas and parts of Louisiana, has a higher incremental cost structure, it simultaneously benefits from access to higher realized prices. Its proximity to the Gulf Coast and Gulf Coast pricing affords a higher realized price, which allows you, even with a higher cost stack, to deliver margins that rival where we already are with Appalachia. So you can see pro forma having owned the assets for the full quarter relative to where market prices were for that period, the margin could have been 54%. But we won't stop there. As we talked about with Appalachia, beginning the process of building scale and synergies and asset density, we'll work to lower that cost, which will further widen that margin, which gives us more optimism that we could be certainly in that mid-50s to 60% cash margin range over time. So that's certainly where we will be focusing the smarter asset management opportunities, and then working to leverage commodity hedging to capture higher prices. So we've talked about the dividends and the return to our equity holder. We also like to talk about the focus on constant delevering to de-risk the business and maintain a very strong balance sheet. If you took, obviously we've been an acquisitive company since 2017. We've funded that with both a mix of equity and with debt, and being responsible never to over-lever the balance sheet, so that we're always in a position of strength while working to roll up additional assets. And if you added up all the debt we borrowed, it would be just about $1 billion over that horizon. And yet at 6/30 of this we had just $635 million of that amount of debt outstanding. So we've repaid since IPO 35% of everything we borrowed. And importantly, 75% of that number sits in structures that you've heard us talk about, the asset-backed securitizations and the similarly structured term loan with Munich Re, that has a very clearly defined amortization schedule over the next decade that has us down to essentially being debt-free by 2030 on an asset that will produce for decades to come. So very, very conservative debt profile. Importantly, we certainly appreciated the equity infusion that we had completed in May to prosecute the 3 acquisitions that we did to enter the central region. But it positions us now with additional financing capacity to continue to consolidate assets on a non-dilutive basis. We sit at just 1.9 times net debt to EBITDA today. And we've always said that our stated target is in that 2 to 2.5 times, which affords us a significant amount of capacity to do non-dilutive growth. And when you partner our capacity with the Oaktree partnership, certainly even deals of a significant size are within reach without the need for additional equity. To create that liquidity, part of that is the revolving credit facility that we had. And you've seen us now for 3 consecutive periods, including as recently as April, talk about the 3 successful redeterminations and reaffirmations of our $425 million borrowing base without contributing any additional collateral, despite the fact we've continued to produce, which really speaks to the durability of that asset base. But now having completed or being in the process of completing 3 transactions in the central region and the contribution of that additional collateral to the credit facility, our lead banks have approved a $200 million borrowing base increase, taking that 425 up to 625 million, which creates significant liquidity for us to move forward and continue to roll up assets. But we're always mindful of the cost of our debt, and I'm extremely proud of the fact that when you stack it all together and you look at our credit facility partnered with our asset-backed securitizations and our term loans, our weighted average interest rate is still under 5%. So an exceptional rate that I think, again, speaks to the low risk and long life nature of the asset, and certainly puts us in a great position to be able to compete for assets as we move forward, because our cost of capital is so much lower than so many others that are competing for the same assets. So as we think about reinvestment and how do we sustain the business and sustain our cash flows period after period while making dividend distributions and while delevering, I think it's important to remind, Rusty talked about the low decline nature, the industry leading low decline nature of our asset base, which prior to the central region acquisitions was just 7%. So what does that mean? How can we both pay our debt, pay our dividends, and continue to grow and sustain the business so that you can have confidence that that dividend distribution is there to stay? And what we've done is we've said, okay, if you take just the first half of the year alone, and you look at our adjusted revenue, which is inclusive of those hedge payments we made, we had $301 million of revenue. You net off all of our operating expenses, including G&A, which takes you to the 50% cash margin, or EBITDA. And then you further layer off CapEx, interest, and cash taxes. That takes you down to $117 million of free cash flow, which is a 40% margin, which is exceptional to begin with. That's a 20% free cash flow yield on our market cap today. And you say, okay, how have we used that cash flow for the benefit of shareholders? And we show 62 million of that goes back in the form of our dividend. We just declared another 4-cent dividend, which has us on a 16-cent annualized, and that's before the benefit of acquiring the central assets that we've talked about. That leaves $55 million of free cash flow that we can reinvest in the business. And we can do that a couple of different ways. We can delever if there aren't assets that we see that we like, that we want to acquire at a multiple that meets our valuation metrics, or that set a decline profile we like. And by delevering, we create liquidity that I can issue financing at a future time to acquire assets without additional dilution. Or I could acquire assets, or I could do a hybrid, a combination of both. And when you compare that 55 million to what does it take to maintain the business, absent in growth, just maintaining the business, you can see what we've done is we said we have 151 million of EBITDA, which you'll recall is the 301 of revenue less our operating costs. That's declining at 7% a year. So that's about a $11 million reduction per year. And we've talked about when we acquire assets, we're acquiring cash flow, and we're generally paying anywhere from 2 to 4 times that. So if you take the midpoint, which is really where we've been purchasing on average our assets over the last couple of years, that 3-time multiple, that's a $33 million investment that we need to make to replace the EBITDA that the declines contributed. And you compare that 33 million to the 55 million, and you can see that our free cash flow is 40% in excess of that number today. So we can take that 22 million and grow the company, or we can take that incremental $22 million and continue to delever and put the balance sheet in a better place for future acquisition. So really powerful and very results-oriented model that hopefully illustrates that that it's not only, you know, a very powerful and robust dividend engine today, but will be one tomorrow. So with that, I'll hand it back to Rusty for a few wrapping comments.
Yep. And so just thinking about the rest of the year and kind of the focus of our operating teams and also our strategy teams here, you know, we're obviously top of the list is integrating the assets we've acquired, making sure that that goes seamless, looking at ways to find those cost efficiencies in the business, which we already have, and also to increase the production on the assets we've acquired. We'll also talk, you know, we talked about ESG and put a lot of time on during this presentation, but we'll continue to enhance and improve and to you know, detect and correct, as we said. And we'll talk more about that in our Capital Markets Day in October. Developing scale and return on capital. Obviously, that's key in this business and what in the model that we have. We'll continue to pursue value additive opportunities. There's no shortage of those. We have available credit that we can do some of that without any kind of equity raises at all. And we'll continue to generate efficiencies and margin enhancing projects within the portfolio that we have to continue to drive the operational scale and the margins higher. We're going to, as always, we maintain our focus on shareholder returns. We've been watching the press releases come out on companies' earnings releases for the quarter. And I told people earlier today that it's really amusing to me to see a lot of these being focused on, and headlines essentially saying we're now focused on shareholder returns. I wanted to say we've been that way for 5 years. That's the way we operate the business. But everybody's getting religion and everybody's trying to get closer to what we've done now over the last 5 years, getting away from growth and getting into return on capital. So we're going to look at ways to continue to improve that. Obviously, the price curve moving up is going to give us opportunities to lock in additional value in the out years, especially from 23 forward, which is where we're focused at this point. We still have some gas that we can hedge in 22, but for the most part, we're focused on 23 and up. And then we'll continue to, as Eric was saying earlier, we're going to start looking at ways to take generated cash flow and grow the company organically, or a percentage of that growth coming from organic cash flow, so that we rely less on equity and make the shares more scarce in the market. And so this is a big focus of ours. We want to be able to reinvest without continual equity investments. So with that, I'm going to stop and I will turn it over and see if there's any questions that we can answer.
Excellent.
That is great. Thank you very much. Yeah, no, I will handle these questions, and we've had an awful lot, so we'll try and get through as many as we can. We'll also take a question, a couple of questions that have come in ahead of time. So anyway, firstly, to say thank you, Rusty and Eric, for that very clear and comprehensive overview of the half-year results, and well done on again for your performance. Firstly, there's a question about, it's coming ahead of time about the share price performance. So what actions are the board taking to improve the share price that has underperformed the sector at a time of high gas prices? And what do the board attribute this performance to?
Yeah, well, I think it's a good question. It's one that I ask every day because we obviously are performing at a high level. We've returned capital to our shareholders. We actually had a pretty extensive review by 3 different investment banks to come in and give us some proposals or recommendations or thoughts around how we get more value out of the company in terms of the share price. And a lot of good things came out of that. The one thing that was surprising to me is that they polled a lot of existing investors, institutional, and none of them had anything they could say about the company other than they've done everything they said they would do. They're growing the company in a very efficient manner, doing the right things. It just seems like the share price has underperformed due to some bad situations with funds that are invested in the shares. We've had, here recently, one of our not biggest shareholders, but in that 15 to 20 range, sell a significant amount of shares because they lost one of their funds. I can't do anything about that. There's nothing we can do. What the problem with that is that when you have somebody dropping that many shares in the market, the liquidity to soak it up is not sufficient. And so for us, one of the things, going through these marketing meetings and doing more marketing with what I would consider to be less large institutional and more intermediate type institutions, high net worth, those kind that can do more acquiring on a daily basis, because we have a great shareholder register. They're full. They trade. They don't trade. They buy and they hold. They clip their dividend and they go on. So we have to, but there's several things that came up in those meetings. We definitely right now, in my opinion, are undervalued. We definitely have underperformed the market from January till now. No doubt about that. As gas prices,
well, really on a U.S. peer basis.
U.S. peer basis.
Look at us, and this was important. A couple of things. If you look at us on the context of the European energy sector, we're not a significant underperformer. In fact, we're about average. There are 2 that have outperformed us, and there are several who have underperformed us. But if you really drill through to that, and I think this goes through to Rusty's comments around the investor feedback we've gotten at the institutional level, where there's not been a criticism, there's not a complaint about our operational execution and continuing to deliver real value, the things that candidly we can tangibly control. If you look at the results, they're exceptional across that universe. And so, the trading dynamics can be a bit difficult to understand, but we are from a sector perspective amongst the peers in which we operate or we sit. From a trading perspective, we're actually in line. It's the U.S. peers that trade far more in line with commodity price than we do, who have outperformed. But part of it, their hedging strategy is different. They don't have the stability of cash flow. They don't have a dividend distribution model. And when you look at as Rusty likes to talk about, the press releases where they're celebrating their investor-centric returns and their significant increases in their dividends, they're going from fractions of pennies to pennies that certainly from a dividend yield perspective take them into the 1% to 2% range, not the 11 to 12% where we sit today. So there's really just some pretty significant fundamental differences.
And lastly, and we've probably spent more time on this question, but I do think it's a great question and one that haunts me day to day. But we haven't performed up to our U.S. peers in a 6-month or 7-month period. But if you go back over a 4-year period from IPO, we've overperformed them by a significant amount. So I think our hedging strategy in times of a significant increase in commodities can kind of cap us out a little bit. And we may get less activity from shareholders or from institutions because of that. But over the long haul, it definitely pays off, because over the last 2 years, those same people that have outperformed us in the first 6 months were performing poorly in a down commodity price environment while we were, performing pretty well. So all in all, I think that's kind of the answer for the question.
Great. No, I think you've covered that pretty comprehensively there. Let's have a look at the next question, which I think you might have answered during the presentation, but just to clarify, do you expect to close any new acquisitions in the second half of this year?
Yeah, we have one that's going to close this month that we've already announced, which is Tanos. We've closed Indigo in May. We closed Blackbeard right after the end of the first half in July, and then we're closing Tanos this month.
Okay. Got a question here. On today's earnings call, you mentioned ESG, but didn't say anything about the E. Can you talk perhaps specifically about how you're addressing environmental issues in existing sites, as well as the new acquisitions, and perhaps where this wasn't always a high priority?
it's always been a high priority. I don't think that's ever.
I think the
may not have
question
been-
was referred to perhaps not a high priority in the acquisitions when they're owned by other owners.
Yeah, I think that, you know, going back to the first comment, we did talk quite extensively. I'm not sure which, I guess the early morning call about the environmental side and how we are, you know, from an emissions perspective, which is the big majority. When you look at us as a company, you know, emissions is the environmental part. You know, when it comes to locations, and we don't drill, we don't complete, so we're not having, you know, we're not permitting and building, you know, well sites and having to reclaim those and all that. That's not part of our business. We have existing production, existing well pads. We are just dealing with, you know, wells that have already been drilled. But the biggest part of that's emissions, and we're heavily focused on that. Two ways. Number one, we're buying this equipment that we talked about. We want to be able to measure our emissions in a more accurate manner, because if you don't measure it with real-time capabilities, you get put in the penalty box of the worst, you know, emissions calculation. So we want to make sure we're accurately reporting it and then driving it down by fixing and tightening up the emissions over time. And so we've got the equipment now. We're buying 100 of the leak detection equipment machines that will tell us where the emissions are occurring, and we can fix them. And so that's kind of the big part of that environmental aspect. But the acquisitions we're doing, it's very clear, especially on these private companies, they're doing the EPA reporting, but they're not trying to measure their emissions. So they're just putting themselves in the penalty box right from the beginning. They're saying, hey, listen, here's what we have. Here's the equipment we have, for example, pneumatic devices, but we're not measuring it, put us in the penalty box, and here's what we're, you know. So we'll have to go in and clean that up. But it's not really an emissions problem, it's an emissions measurement problem. Once we know what the measurement is, then we can fix it.
Yeah, and just for clarity, of course, Brad in his comments did, I think, address all three, the E, the S, and the G. He talked a lot about the LDAR equipment that we've invested in being a step to significantly address emissions. He talked about fugitive emissions and identify where they are so we know to where to invest our time and money, as well as on the E side, the safe and systematic retirement of our wells. Even though we're only halfway through the year, we've met 80% of our plugging obligations, and we've done that in a very safe and cost-effective way. So, you know, we constantly are talking about the E side, and very much as part of the Capital Markets Day that we've announced we'll hold in October, we'll get even more specific with respect to both tactical actions we're taking and financial investments we're going to make to continue the investment in the E side of the equation. Okay,
thank you. Got a question here, which is probably for you, Eric, around hedging. In the 2020 year report, it said 90% of 2021 natural gas was hedged at a weighted average floor price of $2.94. But in the first half 21, it appears that the average hedge price was $2.43. Can you explain the difference?
So I'd have to go back and look at the specifics, but conceptually, I could tell you when we talk about our NYMEX price, which may have been the 294, and that's on an MCF basis as opposed to an MMBTU basis. And that's the difference being the NGL, or the liquids content of our gas stream, is before you deduct basis differentials. And so if you followed, again, the US peers who trade much more in line with just commodity prices in general, a significant portion that put, or a significant dynamic that put real pressure on their earnings and their cash flow was a widening of the basis differentials. You saw that widen out to nearly $1 on some of the systems. And so it became a significant reduction of their realized price. We protect that to a significant degree. We had about 65 to 70% basis protection in place to partner with our Henry Hub protection. So it was much more muted for us in the first half of 2021 than it was for our peers. But that would represent some of the difference between the Henry Hub hedge price and the ultimate realized price.
Okay, thank you. We've had a couple of questions on this one. A couple came in ahead and one in today, which says, are you considering a dual UK-US listing? You know, does does Diversif have any plans to list on a major US stock exchange?
Yeah, well, going back to those investment banks, when we were talking about valuation and how we can improve our valuation, one of the things that they recommended and thought that was a good idea is that we need a US currency. Now, how we get that, is where the debate begins. But it appears to us that our first step is a dual listing, an ADR, a US ADR listing that we can then solicit, market, US institutions, fundraise when needed through that ADR and US investors. So I would say that is becoming more and more of a priority for us, and that we'll start to kick that around pretty heavily in the next few months, and talking and figuring out how we're going to do that.
Yeah, and you'll recall at year end, we introduced that we were very much looking at how to partner some US equity holders with our UK very loyal base. And the dual listing seemed to be the most obvious route. It was certainly helpful to have these large institutions come in and offer us some input. They agreed with that. It seems as though the horizon can be in that 3 to 4 month time frame to put one in place, but that's really driven, I think, to make it work. And there are fewer success stories than you'd like to see. The good news is the diversified model resonates very positively with US investors who are looking for tangible returns, which is why you're seeing the E&P sector on this side of the pond begin to really talk about revenue dividend distributions. So we're well situated, and so when we have the right dynamic, I think you'll see us put the time and effort into list, and I would expect that sooner rather than later, given that it is just a short horizon to put one in place.
Okay, thank you. Question here about the decline rates. It looks like decline rates have increased to 8.5% through the replacement calculation shown on slide 17. Previously, they had showed 7%. Can you comment on where they are currently? And I'm assuming the Appalachian asset SWM benefits have now been maxed out, given the decline in legacy assets production was 70 barrels of oil for about 7 out of 8 quarters, but now dropping a bit. Is there a significant opportunity in the new central region?
Well, I don't think, the difference between the 7% that we stated previously before these acquisitions and now really relates to the fact that if you look at the Tanos and the Indigo transactions, of which we're 50% of both of those, the first year or two of declines in those portfolios are a little higher than, per se the Blackbeard transaction, which was in the Barnett Shale, which is a 7% flat decline rate. It's more mature. We do have some wells in these two acquisitions that were newer. And so those will have to roll off in years 1 and 2. But at the end of the day, that's really the difference between, from a 7% up to an 8.5% decline rate. I think we'll beat that 8.5%. I think that's more of our engineered declines, and we'll do better. But at the end of the day, there is an adjustment where you have to, but that's why we didn't pay a 3.5 multiple for those two assets. We paid a 2.8, 2.9 times multiple, where we paid a 3.5 times multiple, or maybe a little more than that, for the Barnett Shale asset. So you adjust for these things through pricing, you adjust through the valuations that you're paying. But we're very comfortable. Our decline rates are going to stay in that 8% range for the long haul. We're not trying to drive up our decline rates with new production or anything like that. But as these new wells that are in these Tanos and Indigo asset portfolios start to decline further, that decline rate will come in further. And so Appalachia, I don't think Appalachia was materially different from the last quarter that we reported.
No, we talk about Smarter Asset Management successfully held a very large portfolio, essentially declined flat for nearly 2.5 years. And that should have been, engineered decline is around 5%. And so we talked about holding it flat for 2.5 years relative to experiencing 5% declines, created over $54 million of incremental revenue to the company. So significant value. But what I'd say is that very large base now of very low decline Appalachia allowed us to add in 27% more production from the central region that incrementally today is at a higher rate. But every month we move forward, getting shallower and shallower and lighter and lighter. And our incremental corporate decline went from an estimated 7% to 8.5%, despite the fact that we added a third of our production from that central region. That rate will now move down over time, so that when we layer in new assets that have higher declines on the front end, they're against an even larger base of low decline, so their effect is mitigated. But it's important to remember, when we're acquiring assets, you're often acquiring them from companies who previously were developing them and who moved on to a different developmental area. So there's going to be some newer development in the asset mix that's underpinned by a blend of more mature, low decline wells. So I think this is a good example of what you should expect to see. But as Rusty said, our commitment all along has been to a low decline asset profile. And so keeping our declines in the single digits when the next nearest peer is at 12 and the next nearest to that is north of 20 really differentiates our model from anyone else out there.
Okay, thank you. A couple more on the acquisition front. Are you expecting to announce any new acquisitions in the second half of the year? And which mid-continent shale plays do you think are the most appealing for Diversified's acquisition model? And do you also expect to evaluate any mid-continent oil-weighted opportunities?
Yeah, no, well, I can't answer that first question as to whether or not we'll announce another one the second half of the year. I can tell you we're active and we're looking and we're talking, we're evaluating, and so there's always, you know, those things on the horizon. As it relates to what we see in that new central region, I think that, you know, the Barnett Shale, which is a gas play, has a lot of potential, and we would want to potentially add additional scale there. The Cotton Valley, obviously, Haynesville continues to be a top priority, as that's a co-investment with Oaktree, and we want to make sure that we're you know, leveraging that to its fullest. And then, you know, I think, you know, as I look at Oklahoma, I like Oklahoma a lot. I think it has a lot of assets. It's more of a mix. It's not just pure natural gas. It's probably a third oil, a third NGLs, and a third natural gas. So it's a more diverse revenue stream, but has a lot of potential there. So all those areas are focused right now.
Okay, thank you. Again, a couple of related questions. What is the company's preferred route for raising capital to fund their share of the JV with Oaktree? And how much of the existing, I think you said 335 million sort of, I guess, capital or, you know, debt opportunity is available for acquisitions?
Yeah, well, all of it. So, I mean, whatever debt capacity that we have, we'll use it. One of the, I didn't mention this earlier, but one of the suggestions that the investment banks came back to us on as it relates to valuation was, listen, you guys have been very, very, you know, straightforward in what your debt usage would be and where you're comfortable at from a leverage perspective. You've held it pretty close to 2 times, but you probably, it wouldn't hurt you to use a little more and to use more of the top side of your leverage ratio versus, you know, the bottom tier. And that would probably result in a little more accretive value, especially when your equity is trading at 11% dividend yield. And so we heard that, and we, you know, we obviously have debt capacity, and we're going to use it for the next transaction.
Okay. Will you be considering any share buybacks?
It's always on the table. You know, we always have to evaluate how it compares to, you know, from an opportunity perspective, the other alternatives of cash. But yes, that was another thing that one of their recommendations was that you could employ a buyback program to keep the shares, to reduce the number of shares in the market like that. Yeah.
Okay. Question here on government policy. US government policy is to reduce coal electricity generation rapidly. In the medium term, this can only be done through rapidly increasing gas generation. what is the view of the impact on gas demand of this policy?
Well, it's definitely already had the impact. Um, you, you can't, as an administration, come in and talk about how you're going to tamp out carbon, new drilling and all that without it having a major impact on prices, which we're seeing. I mean, we've seen natural gas skyrocket in the US here in the last 30, 45 days. That has nothing to do with other than demand and the supply that's coming behind it. We're seeing reduced supplies. Some of the pipelines that we were wanting to get built have been kind of scuttled for the time being, and that's going to result in higher pricing. And so natural gas is the alternative right now for coal, has been for a while. Coal has kind of plateaued in terms of its use. There's a lot of coal plants still out there that are generating the power, but once that permit expires, they'll roll off into natural gas. So listen, I'm bullish on natural gas. I feel like the table is set for a nice run for an extended period of time.
We come to the end of the sort of the time allotted, but we've got a few questions on the hedge, which I'm just going to try and ask Eric if he can help simplify this. And it's obviously a complicated issue for many people looking at the sort of the headline profit numbers that incorporate the hedge losses and indeed the impact on the cash flow for the company. And I wondered if you can try and explain in layman's terms, in simple terms, how sort of the non-cash hedge losses or profits impact the overall company profitability and cash flow.
Well, so book income candidly doesn't affect cash flow at all, right? There's a lot of non-cash charges that are going through the P&L. The valuation adjustment to your derivative portfolio is one of those, but you also have non-cash depletion charges that are just the amortization of your asset base you're producing. That are going through the P&L. The cash left the door when you bought the asset, and you're systematically charging it into earnings as you go. So earnings are never a good gauge of cash flow, which is why there's a separate statement, the statement of cash flows. And I think if you look at the statement of cash flows, you see very healthy cash flow from operations. And that's because this large derivative non-cash mark-to-market adjustment doesn't affect cash flow today. And if you think about it, what it is it's pulling forward the negative hedge cash flows for 10 years and putting them into earnings today. But I'm not getting the benefit of selling that gas for 10 years in the positive margin. You remember that green bar that went through the graph, that positive margin creating earnings. So there really is a mismatch between my earnings and this liability charge. And you're eligible to get that accounting if you go through the process of doing accounting hedging. We just don't do that for a variety of reasons. But it's just really important to make sure that we focus on cash flow. And that's why the bulk of our presentation today was let's look at the cash flow generation. We have stable, consistent, and elevated production as we continue to grow the base. We've hedged at a price that's very, very positive to us. It generates a 50% operating margin. That's after all operating expense and all administrative expense. So that 50% is available to us to fund our taxes, which we didn't really talk about, but if you look at our tax rate within the mid-year report, it reflects a tremendous benefit from a tax credit that we're afforded on some of our more legacy conventional assets in Appalachia. We earned an $80 million, what they call marginal well tax credit. And at a 21% tax rate, that will offset nearly $800 million of future taxable income. So it offsets a tremendous amount of future cash taxes. So again, we're talking about cash flow. It's a tremendous asset to the investor because it provides more cash flow to dividends as opposed to debt payments. But I always are mindful, we talked about the E and the S and the G, the S, the social aspect. I never want to take away from the fact that we pay tens of millions of dollars in operations taxes to the local counties and jurisdictions where our assets exist through production taxes and property taxes. But at the federal level, we receive this benefit. We also pay significant state income taxes in the states where we operate. So we are a taxpayer, but we do get a significant federal tax benefit. So just remember, so to try to distill that, the hedge market loss you're seeing is non-cash, so no effect on cash flow. Our cash flow is very, very positive. And we're going to have positive cash flow for 10 years against that hedge payment stream that today is valued at 537 million. But if prices come down, that liability quickly comes down. And if they go up, it'll go up as well. But so too will the value of our cash flow in the future.
Yeah, I mean, you go back to last year at this time and you look at the value of that hedge book. It was the same hedge book. It had hardly any value, negative value to it at all because prices were down. And so the way I look at it is this: you've got near term, and I've always said this thing should be kind of like debt. You've got current maturities and you got long-term debt. The current maturity is what you're actually going to recognize in the P&L cash-wise in the next 12 months. The rest of it is so far out, and it could change tomorrow. It just depends on where the cash, where the market price goes. So we had 117 million of free cash flow this half but that shows up in your book value or your book earnings as a big negative. It's just not something that you should focus on. It's a good indicator of where the strip price is for sure versus the hedging that we have in place. But the hedges we have in place, as Eric was saying, provide us a 50+% margin. So it's not like that's going to impact us from that perspective. And then the last thing I would say is that if you go back and look, every company that's reported earnings has had the same issue. Huge hedge losses because most people were putting on hedges over the last 6 to 12 months that banks and institutional investors were requiring because we just went through a 2-year period of terrible gas and oil prices. So people were hedging. Now we've seen a big spike in prices and it's showing up in the non-cash items. So that's essentially what it is.
Eric and Rusty, thank you very much for answering what was a difficult question right at the end, but also for presenting so clearly today. And there have been a few comments that say, well done on a consistent delivery, and thanks for continuing to increase the dividend over time. So thank you for that presentation. As you leave today, you'll be coming to a short survey for feedback for management. We really appreciate it if you could complete that. And just to flag up a couple of forthcoming webinars we've got coming up in the coming weeks and months. A couple of weeks time, August the 19th, we've got Kenmare Resources who report their half-year numbers on the 18th. And then on September the 23rd, we have a Crossword Cybersecurity. So thank you to the management team at Diversify today. Thank you for all attendees for coming along, and we would hope to see you all soon. Thank you.
Thank you so much. Appreciate it.
Thank you, guys. Thank you, everyone.
Bye-bye.